The silence that follows a financial execution is heavier than the noise of the panic itself. You are sitting there, looking at the wreckage of the last few days, and you are trying to make sense of a crime scene where the weapon was a computer algorithm and the victim was your peace of mind. The charts tell you that silver collapsed. The headlines tell you that the bubble burst. The experts tell you that the dream is over. But deep down, in the quiet part of your mind that still remembers why you started this journey, you know that something is wrong. You know that what you just witnessed was not a natural event. It was not a market deciding that silver had lost its utility. It was not a collective decision by millions of investors to sell at the exact same second. It was a surgical strike. It was a calculated, mechanical, and ruthless operation designed to strip the leverage from the system and transfer wealth from the hands of the fearful to the hands of the ruthless. This is the final warning, not a warning to sell, but a warning to understand. Because if you do not understand the mechanics of the smash that just occurred, you will not survive the volatility that is coming next. And surviving what comes next is the only way to participate in the greatest wealth transfer in human history. We need to dissect the anatomy of this crash with the cold precision of a coroner. We need to look at the body of the market and determine the cause of death for the recent rally. The official narrative is that the dollar strengthened, or that interest rates remained stubborn, or that geopolitical tensions cooled for a nanosecond. These are lies. They are convenient stories draped over a much uglier truth. The truth is that the market was murdered by margin. In the world of futures trading, margin is the leverage that allows speculators to bet with money they do not have. It is a powerful drug. It makes the highs higher and the lows lower. But the dealers, the banks, and the exchanges control the supply of that drug. And on Monday, they cut the supply. When the exchange raises margin requirements, it is not a suggestion, it is a demand. It is a gun to the head of every trader who is overextended. It says, put up more cash right now, or we will sell your position for you. And in a market that had become crowded with tourists, with people chasing the green candles without understanding the fundamental thesis, there was no cash to put up. So the selling began. But it wasn't human selling, it was robotic selling. It was algorithms triggering stop losses, which triggered more margin calls, which triggered more selling. It was a cascade, a waterfall of liquidation. This distinction is the most important thing you will learn today. There is a difference between a market correction and a liquidity event. A market correction is when investors look at an asset, decide it is overvalued, and choose to sell. It is a rational debate between buyers and sellers. A liquidity event is when traders are forced to sell, regardless of value, because they are insolvent. They are not selling because they hate silver. They are selling because they have to pay the broker. What we saw was a liquidity event. It was a forced liquidation. And the defining characteristic of a forced liquidation is that the price disconnects from reality. The price goes lower than any rational analysis would justify simply because the sellers have no choice. So, who was on the other side of that trade? When the tourists were puking their positions at the bottom, who was buying? It wasn't the other tourists. They were too scared. It was the banks. It was the smart money. It was the very entities that engineered the smash. They watched the price fall, they waited for the panic to reach its crescendo, and then they stepped in and swept the floor. They bought your silver at a discount, they stole your position, and now, as the price begins to violently rebound, they are laughing. They have reset their cost basis, they have covered their shorts, and they are ready for the next leg up, leaving you behind in the dust of your own fear. But this smash was not just about profit. It was about survival for the paper market. You have to understand that the paper market, the COMEX, the LBMA, the ETFs, is a fractional reserve scheme. For every ounce of physical silver in the vault, there are hundreds of paper ounces traded. It is a game of musical chairs played with $1 billion on the line. As the price of silver was skyrocketing towards $100, more and more people were demanding delivery. More and more people were asking for the physical metal. The chairs were disappearing. The banks were facing a failure to deliver. If they had allowed the price to keep rising, the run on the vaults would have become a stampede. The default would have been exposed. So, they smashed the price. They used the leverage bomb to nuke the sentiment. By crashing the price, they scared the paper holders into selling. They convinced the world that silver is a bad investment. They stopped the run on the vault. They bought themselves time. But they did not solve the problem. They only kicked the can down the road, and the road is ending. Because while they can manipulate the paper price, they cannot print physical metal. They cannot conjure silver out of thin air, and the physical reality of the market is tighter than it has ever been. Let's look at that physical reality. While the price on your screen was plummeting, did the solar panel factories stop running? Did the electric vehicle assembly lines shut down? Did the AI data centers stop needing high-efficiency connectors? No. The industrial demand for silver is a juggernaut. It is a force of nature. It consumes over 1 billion ounces a year. It does not care about the spot price. It cares about physics. Silver is the most conductive metal in the universe. You cannot build the modern world without it. You cannot build the green energy transition without it. You cannot build the military-industrial complex without it. This demand is inelastic. That means that the factories will buy silver whether the price is $20 or $200. It is a tiny fraction of the cost of their final product, but it is essential. They cannot substitute it. They cannot thrift it away any further. They are trapped. They have to buy, and they are buying. We are seeing record offtake from the Shanghai Gold Exchange. We are seeing inventories in London and New York draining to historic lows. The smash in the paper price actually makes this problem worse for the banks. By lowering the price, they have put silver on sale for the industrial users. They have incentivized China and India to buy even more. They have accelerated the drainage of the very vaults they are trying to protect. This is the paradox of the smash. It works in the short term to clear sentiment, but it destroys the system in the long term by depleting inventory. It is a desperate move. It is the move of a gambler who is doubling down on a losing hand. And this is why I call it the final warning. Because you may not get another chance to buy at these levels. You may not get another chance to secure your position before the physical shortage becomes undeniable. When the vaults are finally empty, when the force majeure is declared, the price will not drift higher. It will gap higher. It will open at a multiple of the current price, and there will be no sellers. The psychological warfare that accompanied this smash was intense. The media, which is owned by the same corporate interests that benefit from the fiat system, was screaming that the silver bubble had burst. They wanted you to feel foolish. They wanted you to feel isolated. They wanted you to regret your purchase. This is gaslighting. It is designed to break your conviction, because conviction is the only thing that can defeat their manipulation. If you hold the physical metal, if you do not use leverage, if you refuse to sell, their games cannot hurt you. They can only hurt the gamblers. The tourists are the ones who got hurt. The tourists are the investors who arrived late, who didn't do their homework, who treated silver like a slot machine. They saw the price going up and they wanted free money. They didn't understand that silver is not an investment. It is a war. It is a war between real money and fake money. It is a war between the sovereign individual and the bankrupt state. And in war, you take casualties. The tourists were the casualties. They were the ones who sold at the bottom, but you are not a tourist. You are a resident. You live here. You understand the landscape. You know that volatility is the price of admission. You know that the banks will fight dirty. You expected this, and because you expected it, you did not panic. You looked at the red candles and you saw opportunity. You saw a flash sale. You saw a chance to lower your cost basis. You saw the desperation of the enemy. Now we must look forward. What happens next? The rebound we are seeing today is violent. That is to be expected. When you compress a spring, it snaps back. The sellers are exhausted. The shorts are covering. The value buyers are stepping in. But do not be complacent. The market has been damaged. The structure has been broken. We are likely entering a period of chop. This is the phase where the market grinds sideways. It is the boring phase. It is the phase designed to wear you out. The crash was designed to scare you. The chop is designed to bore you. They want you to lose interest. They want you to move on to the next shiny object, the next tech stock, the next crypto coin. They want you to forget about silver so they can accumulate it in peace. Do not give them that satisfaction. Stay vigilant. Use this time to build your position. Use this time to educate yourself. Use this time to harden your mind. The paper versus physical disconnect is going to get wider. We are already seeing premiums on physical coins and bars staying high even as the spot price drops. This is the market telling you the truth. The spot price is a lie. The premium is the reality. The premium is the cost of certainty. It is the cost of holding an asset that is not someone else's liability. As the paper market becomes more volatile and less reliable, the physical market will decouple. We will see a two-tiered pricing system, the paper price for the gamblers and the physical price for the owners. And the physical price will be much, much higher. We must also talk about the supply side of the equation. Silver is unique because most of it comes as a byproduct of mining for other metals like copper, lead, and zinc. This means that the supply is inelastic. If the price of silver goes up, the miners cannot simply produce more. They are mining for copper. Their production is determined by the copper market, not the silver market. They cannot turn a dial and increase silver output. And with the global economy slowing down, the demand for base metals is softening, which means silver production could actually fall even as the price rises. Furthermore, the primary silver mines are aging. The grades are falling. We have not found a major new silver deposit in decades. The easy silver is gone. We are now scratching at the earth to find dust, and the cost of mining is skyrocketing. Energy costs, labor costs, regulatory costs, everything is going up. This puts a floor under the price. The miners cannot afford to sell below their cost of production. If the price stays low, the mines will shut down, supply will collapse, and the shortage will get even worse. This creates a perfect storm for silver. Falling supply, rising demand, and a paper market that is suppressing the price. It is a coiled spring. It is a powder keg, and the fuse is lit. The banks know this. That is why they are so desperate. That is why the smash was so violent. They are fighting against gravity. They are fighting against geology. They are fighting against math, and they will lose. The final warning is also about the geopolitical landscape. The world is fracturing. The East is rising. The BRICS nations are accumulating gold and silver to back their currencies and settle trade. They are tired of the weaponized dollar. They are tired of their reserves being devalued by American inflation. They want hard assets. China is importing silver at a record pace. India is importing silver at a record pace. They are draining the West of its real wealth. Every ounce of silver that is sold by a panicked Western investor is being bought by a strategic Eastern buyer. It is a wealth transfer of epic proportions. We are selling our family heirlooms for paper scraps. We are trading our strategic reserves for digital digits. It is a tragedy, but you do not have to participate in it. You can be on the right side of the transfer. You can be the one holding the metal when the music stops. The path forward will not be a straight line. There will be more smashes. There will be more volatility. The banks are not going to give up easily. They have too much to lose. They will use every trick in the book. They will change the margin rules again. They will paint the charts. They will release bearish reports. They will use their media mouthpieces to spread fear. You must be prepared for this. You must expect it. But remember this, they can print currency, but they cannot print trust. And trust in the fiat system is collapsing. The debt is exponential. The deficits are unsustainable. The inflation is structural. The people are waking up. They realize that their money is broken. They are looking for a lifeboat. And silver is the most undervalued lifeboat in the world. When the masses finally rush into silver, the market will break. The silver market is tiny. It is a rounding error compared to the stock market or the bond market. If even a fraction of 1% of global capital tries to enter silver, the price will go vertical. It will not be a bull market. It will be a supernova. The unobtainium phase will begin. You will call your dealer and he will say, "I have nothing to sell." The price on the screen will be irrelevant because there will be no metal available at that price. This is why you must buy now. You must buy when it is available. You must buy when it is unloved. You must buy when the tourists are selling. This is the contrarian way. This is the way of the wealthy. Buying low and selling high sounds easy, but it is psychologically brutal. It requires you to act against the herd. It requires you to trust your analysis more than your emotions. The smash was a gift. It was a chance to verify your conviction. If you held through the crash, if you bought the dip, you have graduated. You are now a veteran of the Silver Wars. You have earned your stripes. You have proven that you cannot be shaken, and that strength will serve you well in the days to come, because the volatility is not over. The chop will be frustrating. It will test your patience, but patience is the key. The fundamentals of silver play out over years, not days. The debt cycle is a long cycle. The supply crunch is a slow-moving crisis. You have to give the thesis time to work. You have to let the physics take over. Do not try to trade this market. Do not try to time the tops and bottoms. You are playing against algorithms that are faster than you. You are playing against insiders who have more information than you. The only way to win is to not play their game. Buy the physical metal, put it in a safe, and wait. Wait for the inevitable. Wait for the math to resolve itself. The final warning is simple. The window is closing. The cheap silver is disappearing. The paper game is ending. The physical reality is asserting itself. Do not be left holding paper promises when the real wealth is gone. Do not be the person who tells their grandchildren, "I almost bought silver before the Great Reset." Be the person who says, "I bought silver, and that is why we are free." The banks have fired their shot. They have used their biggest weapon, the margin smash. And the market is still standing. The price is rebounding. The demand is record-breaking. They failed. They failed to break the back of the bull. They only managed to make it angry. And an angry bull is a dangerous thing for a short seller. We are watching a slow-motion train wreck of the fiat system. You cannot stop it. You can only get off the tracks. Silver is off the tracks. It is the safe haven. It is the insurance policy. It is the battery of the future. It is the money of the people. So, take a deep breath. Ignore the noise. Look at the fundamentals. Look at the debt. Look at the supply. Look at the demand. The case for silver has never been stronger. The price is a lie. The value is real. Hold the line. Stay disciplined. Do not let them steal your future. The smash was the darkness before the dawn, and the dawn is coming. The dawn of a new era of sound money. An era where an ounce of silver buys what it is truly worth. An era where the manipulators are bankrupt and the savers are rewarded. This is your time. This is your opportunity. Do not waste it. Do not let fear dictate your destiny. Seize the moment, accumulate, protect, prevail. The warning has been issued, the market has spoken, the physical is winning, the paper is dying. Which side are you on? The next 90 days will be critical. We will see the battle intensify. We will see the desperation of the shorts increase, but we will also see the resolve of the longs harden. We are building a base of strong hands, a base that cannot be shaken. And from this base, we will launch to heights that will seem impossible to the skeptics. But they are not impossible. They are inevitable. It is just math. And math always wins. So stand tall. You are right. You are early, and you are winning. The red candles were a test. You passed. Now get ready for the reward. Get ready for the realization of value. Get ready for the true price of silver. It is coming. It is unavoidable, and it will be glorious.